All right, it's not looking so good for the market, actually. The Nifty is down about 40 odd points. The Sensex is down 170 points. And the pressure actually is coming in the broader markets for sure. The pocket that is on the top of the ladder as far as the losing end is concerned is IT. So Infosys, TCS, Tech Mahindra, Wipro, all down anywhere between half to about 2 odd %. And then we have a couple of other, heavyweights like SBI that are leading from the front on the downside. But M&M reported an operationally strong Q3 numbers. The revenues are up 40% year on year. Margins are up 130 basis points. Let's get to the bottom of what the outlook is for the business. It's been one of the strongest stocks in the auto space in the last 1 year. We have Dr. Anish Shah, who's the MD and CEO of M&M, who joins us now on the show. Anish, thanks a lot for joining in, and it's a pleasure having you on CNBC TV18. I wanted to first start with the auto segment because it's been a really strong showing that you've seen now in terms of your revenue market share in the SUV segment. It's 4 consecutive quarters of #1 player there. Can you tell us about what the long-term outlook is in terms of growth, particularly for the auto business? What's the sustainable growth that you see? And given that there's an influx of new launches coming in from several players this year, what's your strategy in terms of gaining more market share?
Sudhir, good morning. Glad to be here. You're right, we've seen great performance on the auto side. And going forward, we continue to see tremendous strength in the new launches that we've had over the past year or so. Both the XUV700 and the Scorpio N, after a very strong launch, continue to get bookings that are far in excess of our capacity. We have taken our capacity up about 55 to 60%. We will take it up another 40% in the next 12 months, effectively doubling the capacity in the auto business. A booking backlog today is 266,000 vehicles, and the wait times are much longer than what we'd like. But with the capacity increase, we should be able to get those wait times down. So in all, we feel very strong about where we are right now. The XUV400 has seen over 15,000 bookings already in a very short time period. And therefore, over the next couple of years, we continue to be very positive. The next big growth area for us is international, which we have not been able to focus on given the very strong demand in India. So that will add another kicker in terms of our auto business.
Anish, hi, good morning. Prashant here. Can the automotive segment margins climb up to 8% by next year, by FY24? That is one. On the tractor side, things have been a bit more subdued, haven't they? Margins have expanded, but much lower than what analysts were estimating. On the tractor side, has there been a bit of an issue in terms of passing on, input price hikes, etc., to end consumers?
So on the auto side, we've seen OPM go up 320 basis points. We made a commitment for a 300 basis point increase about a year ago. And we had said it would happen in the medium term. It's happened faster than we expected. We will see more upside in auto margins, both with regard to the operational leverage we will get from higher volumes, as well as what we are seeing on the commodity side right now. In farm, we've actually seen a very strong performance overall, not just in the industry, but our business as well, because we've grown market share 140 basis points. The industry today is at a very strong growth rate coming off 2 very strong years. And therefore, the contribution of the farm business to our profitability has been very high as well. On the margin side, you're right, it has been slightly lower than what we've seen on the auto side, but recognize that there's also an impact there from a rapid growth in farm machinery. And that's a segment where we're looking at a 10x growth in the next 5 years. So we will put in more investments there that will have some impact on margins as well. But overall, margins are still very strong, far higher than anyone else in the industry, and continuing to grow.
Okay, so you're saying 10x growth in the next 5 years. I did see that in your presentation as well. You spoke about how the industry can grow 10% in FY24. What is the outlook for M&M itself in terms of growth in the farm equipment business? And you're already at market share of around 41%. Do you plan to grow that further? Any targets there by the end of FY24?
So in terms of market share at 41%, it's important for us to maintain some sense of realism as well as pragmatism in the industry. So no targets for market share except for the fact that we will maintain it. But the bigger growth area for us, as I mentioned, is farm implements. which is where we will really look at a 10x growth. And there, our market share is a lot lower right now. And for us to just get to a 40% market share itself will give us much of the 10x growth.
Okay, in the auto segment, I just, I wanted your views on the changes that we're going to see in the auto sector post the RDE norms coming through. I mean, there is an expectation that there will be a further shift to petrol variants, diesels could take a back seat. Would you agree with this hypothesis? And if that does come through, then what do you think the impact would be on M&M?
So the cost increase for us is actually minimal. And we've talked about that earlier. We have seen others talk about higher cost increases, but for us, the work is done. It's really not much of a cost increase. These are vehicles with better emissions, so we actually expect diesel to pick up more as a result of that. But for us, it works both ways. We've got some of the best petrol engines in the industry. We've had many of our auto experts as well talk about that. So whether it's petrol or diesel, I think we're well positioned.
Anish, just to go back to the SUV segment, which you alluded to, you gave us numbers, right? You said 266,000 units is the order book there. At the end of the second quarter, that number was 260,000. And as of 1st of Feb, that's 266,000. So while it has grown, I mean, it's very, very marginal, right? Could you tell us, is it seasonal or something else, or is the pace of is the pace slowing down a little bit?
So a big reason for that is we increased capacity significantly. So in the last quarter, we've added capacity of about 55 to 60%, and that has helped us keep this in control. We've seen cancellations to the tune of 10 to 12%, which is normal in this case, especially given the long wait times. So on balance, we are glad it's not growing. We actually want to bring it down as we go forward, as we continue to add capacity. It's not healthy for us to have such long wait times. It's something that we feel for our customers there, and therefore we're trying to increase capacity as quickly as we can to bring down this order backlog.
Oh yeah, I mean, consumers would love that. As you said, Anish, just one point on semiconductors is what's the issue? Because when one looks at what's happening to prices, capacity utilization for some of these semiconductor makers, one gets a feeling that there's actually not a shortage but a glut in some markets. But are you actually getting this through the steady? I mean, has it normalized the semiconductor situation for Indian automakers, including Mahindra?
It's far better than what it was a year ago, so we're not seeing any major issues. But we do continue to see minor blips from time to time, where we are sometimes forced to manufacture 2,000 units less than what we'd like in a particular month. So the impact is far lower at this point, but it's not completely normal as yet.
Okay, well, getting the waiting period down by doubling your capacity, I think that's music to the ears of investors and consumers. I can't tell you. I must use this opportunity to tell you that on a daily basis, on a weekly basis, I get calls from people telling me that, can you please request the M&M management to speed up our delivery?
Plus one.
I know that it speaks a lot about the demand for your products, but it's really tough from the consumer's end. So glad to know that you're doubling the capacity there.
Yes, it's painful for us as well. So it's something we really want to be able to deliver quickly.
I'm sure if we get requests like that so frequently, I can just imagine what must be happening with you guys. But, the other big trigger that the street is looking at is the growth in the electric three-wheeler business. I mean, this time you saw the highest ever volumes there at 11,800 units. Just tell us, what is the growth plans with the electric three-wheeler business? Would you be raising capacity there as well? And what kind of volume growth would you be penciling in?
So we are increasing capacity. We will talk more about volume growth in the near future on that. But all I will say right now is we've added that to our growth gems, because it's a business that has a very aggressive plan. It's a business that will get to $1 billion of market cap. In 3 to 5 years, I would probably say it's going to be more in the 3-year time frame. And at this stage, all I'll say is stay tuned for this, more to come in the next few weeks.
So you're saying electric three-wheelers as a business will get to $1 billion market cap in the next 3 to 5 years overall for the industry?
This is our business. So M&M's last mile mobility, the three-wheeler business, we are targeting a $1 billion market cap in the next 3 to 5 years.
This is a slightly, zooming out a little bit, but this news, the news that The J&K has been sort of found to have a large lithium deposit. The inferred deposit is some 5.9 million tons, which would be about 5.5% of the identified reservoirs. Any thoughts on this? I mean, how significant could this be? I mean, this is, of course, as I said, slightly a longer-term question, but any thoughts?
This is very positive for India because we will look at indigenizing battery capacity, cell capacity in future, and having raw materials within our borders, I think is a very positive, especially with regard to lithium here. So I think it's a great find and something that augurs well for the auto industry in India.
All right. We'll leave it there, Anish. Thank you very much. Great chat as always, and good luck from all of us here at CNBC-TV18. Hope to speak with you soon again.
Thank you, Prashant and Sonia.
All right, thank you. Well, 40 points lower is what we have on the Nifty at this point in time. But, I mean, the thing is, we've come off the highs, but it's not kind of one way or anything of that sort at all. It's balanced. Cummins India reported a strong set of third quarter numbers. There was a beat on estimates. The revenues are up 26%, but margins are the real sort of kicker. EBITDA in absolute terms is up 52% as well. The company's witnessed strong demand from end markets like data centers, commercial real estate, rental, healthcare, telecom, mining and railways. Ashwath Ram is Managing Director at Cummins India. He's joining us right now to take some questions. So good morning. Great to have you with us here. Thank you very much for your time. I want to just start with, margins, which have come in at 17.5%, and they were under 14%. Same period last year, same quarter last year. The margins are the highest since FY14. Could you tell us if these margins are sustainable? What should we expect going forward?
It's certainly our attempt to sustain the margins. So that's what I guess we are getting paid for. Margins are better because of a couple of reasons. One is we had very significant commodity increases in the last 2 years. And to combat that, we've taken quite a few price increases. And some of the commodities have started to soften over the last couple of quarters. So in the previous quarter, we saw the positive impact of commodity softening, holding the price increase, and continuing to focus on cost and being a cost leader. So the combination of all of those three activities has led to better margins.
All right. Hi, Mr. Ram. Good morning, and thanks so much for speaking to us here on CNBC TV18. In terms of the margins of the past quarter, I had a particular question on other expenditure. Now, your revenues were up by close to around 11%, but other expenditure was lower by close to around 4%. I was going through your con call as well, and you said there was some element of one-off. So my question to you is, could you quantify what was that? If you could give us a quantum out there. And what should the other expenditure look like going ahead? As a percentage of sales, for the past quarter, it came down to sub 8%. Prior to quarters, it was between 8 to 9% on. Go ahead, sir. Quantify that other, in other expenditure, what was the one-off?
Yeah, the other expenditures have got multiple line items. They've got, sales, commissions, they've got one-time charges, etc. So this one was related to some intercompany royalty payments, etc. And those have gone away for this quarter.
Okay. All right. So what was that? How much, what was the quantum of it in this total expenditure?
I can't quantify the exact number over there. I don't have it with me. I should be able to provide it in the future. But that was the major portion of the other expense difference last quarter versus this quarter.
And will you say that it's a one-time number, or whatever benefit you got, will it continue in the time to go ahead, the intercompany royalty, or a couple of line items you're talking about?
The other expenses has got multiple categories, and so it's very difficult to say that this exact advantage which we got in this quarter will continue. But our objective continuously is to try to keep working on all costs in all areas and to continue to maintain or improve our profit margin. So I can't say exactly that it'll be exactly in the same way, but of course it's our endeavor to try to optimize and maximize the profitability.
Got it. Okay. Then what should the margins look like, Mr. Ram? Because as you said, input costs cooled off, but out of nowhere, China reopened, and I tracked the commodity prices very closely. They have started moving up yet again. So what should be the sustainable margin band that the street should work with?
See, the margin we have achieved now is amongst the best. Like you mentioned, it's the highest margin we've achieved in quite a few years. And this is the level of margin I think we are trying to hold. Commodities certainly are a worry because while some commodities have softened, others have started to increase. And with China starting to bounce back, there is a fear that commodities will increase again. So we need to, which means we may need to hold the prices and also need to continue to work on cost optimization.
Can you tell us a little bit more about the export revenues? This time there was, I think, a 25% pickup that you saw and a little over 540 crores. But are you witnessing any slowdown in any of the export markets? And is this a run rate that you can maintain even in Q4 and in FY24?
So we've now maintained this run rate for a couple of quarters. And certainly we sell product in 140 countries around the world. And so the story is not the same everywhere. There are some markets, such as in Africa, where realization is getting difficult. Europe certainly is slowing down a little bit. But other markets in Asia, markets in Latin America, North America, those continue to be strong. We remain optimistic that we'll be able to continue this level of export growth, primarily because the power generation market, which is our main export area, has come in from, has had multiple years of slowdown in the past. And so we think the growth that we have gotten should sustain at least for a couple of years before it begins to normalize.
So despite this slowdown that you're saying, yes, got that. Just in terms of numbers, Mr. Ram, despite this slowdown that you're seeing in Africa as well as in a couple of other pockets, you'll still maintain that 500 crore per quarter run rate in the export revenues?
Yeah, we are attempting to do that. So like I said, there may be a few quarters up and down a little bit, but our goal is to try to do that, try to see if we can even grow it even further. So certainly that is our own internal ambition to maintain the export revenue. Were it not for some very significant geopolitical issues or some very big meltdown, I don't see a very big concern at this time as far as maintaining that.
All right, Mr. Ram, thank you very much. It's a pleasure. Appreciate you joining in with that perspective. Always great having you with us here on the channel.
Thank you.
We are at the low point of the day, by the way, mind you, on the Nifty. We are down 80 points, and this is a firm sort of tick down. 17,774 is the low. We're at 17,776. Mitesh is with us for a quick check on things and how he's reading the screen. Mitesh, correct me if I'm wrong, you wanted to look for maybe the market to break out, but, well, it's not. I don't know if this is a breakdown, but it's firmly lower. Your thoughts now?
As I said, I would want to see either a breakout or breakdown because we have been maintaining a range-bound kind of an outlook, and I think 17,750, 700 is the lower end of the range. So I think if we start getting below 17,700, I think we'll attempt shorts definitely for sure. But till then, I think the idea is to be trade with stock-specific biases, and I have one sell and one buy. Manappuram is something which is breaking down. That's a sell with a stop at 114.5. Look for targets of around 105 on the downside. And the other one which I like is Escorts. It's come off a bit from the day's high, but that's a buy with a stop below levels of 20.45 and a target of around 21.50 is what I'm looking at.
Okay, thanks a lot for that. Not looking good for the markets at all. Sensex now down almost 300 points. Not a good start to the week. Thanks, Mitesh, for joining in. Let's take a quick break. Manisha Gupta will be here with the commodity market check. Welcome back. Let's get you a quick update on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
I'm looking at the precious metal prices because we have seen 3 weeks of decline for this one, and this week as well has started on a weaker note here. Well, it has to do with the fact that the US dollar has continued to strengthen, and that's weighing on to many of these metal prices right now. When you look at the month of January or 2023 for that matter, The gold posted its best start to January in a decade, and we saw 6% of gains come in for the month of Jan there. And when you look at the global central bank in the previous year, that was at a record at 1136 tons as well, and nearly 800 tons of that buying came in the second half of this year. But take a look at the prices on what we've done in last 3 or 4 weeks and last 1 month to be precise. We have seen the gold prices decline by 3.5%. Silver is down more than 10% now, and you have copper prices as well declining 3%. Last 2 to 3 weeks, almost all metals, whether it has been precious metals or base metals, have seen a decline. And the major binding thread between all of that clearly has been the dollar index, which is seen inching towards 104 right now. For the precious metals, it also is various other things. One, there is hawkish signals now coming in from the US Fed and expectation that you could be looking at further rate hikes as well coming in. Second is the Russia sales in sense of gold, where we do understand via various reports, and this one is coming in from World Gold Council, which say that 3.6 tons of gold has been sold to fund its debt. So there's that amount of gold coming into the markets as well. And the Chinese longs also have seen some unwinding. The last $80 of a jump up that you saw in case of gold prices, much of that speculative buying was coming in from China, and there is some profit taking there. Higher import duty also continues to weigh. We have seen that come in for silver. So with 15 to 18% of an import duty for gold, that seems to be weighing in. And then Indian imports have continued to slip in the month of December, and January and Feb as well has seen slow uptick. The investment demand, the jewelry demand also has been on the weaker side. The jeweler industry tells us that in the month of Jan and Feb, they have seen 50 to 70% of a decline in regular jewelry buying, and that continues to weigh in as well. Investment demand also is weak. The global ETF report continues, reports outflows for the 9th straight month. So the investment demand in that sense also has continued to decline. All of that continues to weigh in case of gold. The chartists tell us that 1850, if that breaks on the lower side for the gold prices, we are headed for 1830 then.
Okay, thanks a lot for that. Well, let's go across to Rima now. She's tracking Coforge and the big moves over there. Rima, over to you.
Hi, thanks so much for that. So early in the morning, Coforge saw a very large block deal of nearly 10% equity, which took place at a price of 4,050 roughly, valued at nearly 2,500 crore. What we understand is that Barings, the promoter of Coforge, is the likely seller in the block deal. Now, with this, if it is Barings promoter holding comes down from 70%, the peak in September of 2020, now down to 30%. Barings has been continuously selling stake in the company, and as you can see, in a span of 2.5 years, they've sold down stake from 70 now down to 30%. The previous stake sale had taken place in March of 2022, less than a year ago, at a price of 4,267. So this stake sale has happened at a lower price. Now, the company reported their numbers in the middle of January. It was a good set of numbers. They had gone ahead and raised their full year growth forecast to 20%, 22%. They had seen their highest ever order intake, but the stock is also fairly expensive at 24 times forward multiple. Last week, Nomura initiated coverage on the stock with a buy rating, target price of 5,050. They expect Coforge to outperform the industry in terms of growth rate, so they're penciling in an EPS growth of nearly 25%. But according to them, the risk is of a large stake sale by Baring. Part of it is played out, but Baring still has about a 30% stake in the company. And the question is, what will they do? Will they look to sell it down further or keep it at these levels? Back to you.
Okay, all right, Rima, thanks a lot for that. By the way, on the index itself, we've broken 17,750 and we're trading about those levels. If the Nifty needs to bounce, it needs to bounce from these levels. But let's talk about another stock that's getting a hard knock, Lupin. Ekta joins us to tell us more on that. Ekta?
Thanks for that. Well, a couple of key important points from the brokerages with regards to Lupin is that the cost reduction efforts, according to them, were inadequate by the company. The margins have fallen short of the trajectory required to reach around 16 to 17% by FY24 as well. The guidance, in fact, was a reduction of around 500 to 600 odd crores 2 quarters ago, and the company has in fact resulted in a cost escalation of around 200 odd crores. There are concerns over the EBITDA margin guidance of 20% by Q4 of FY24 to FY25. This is without Spiriva generic and inhalation product, which is one of the key products in their portfolio. Spiriva generic, in fact, has been delayed from FY23 to the first half of FY24. The target action date is likely now in April to July. This is depending on a US FDA inspection. Remember that Spiriva generic now becomes the most critical to sustainable growth as well as margin recovery, according to analysts. Incred, for example, is estimating around $75 million of revenue from it in FY24, going up to $120 million by FY27. It could be up over 25% in terms of the core earning estimates by a lot of analysts. Bernstein market performed, target price of 572. According to them, numbers disappointed again. The costs continue to escalate. Incred has said the improvement is below the asking rate. They've maintained a hold. Nirmal Bang has downgraded the stock to sell versus accumulate with a target price of around 655. So there's clearly disappointment really on the cost reduction efforts and the margins for the company. And Spiriva Generic is your next port of call for Lupin.
Okay, thanks a lot, Ekta, for that. Let's slip into a quick break on that note. On the other side of the break, our special segment, it's the economy.